Right. Hi there. Welcome to today's webinar. It's great to be here. It's Ed Croft, and there's still lots of people coming in, and we should be having quite a fun time. Okay, this is all going to be about how to read a stock report. It's about learning to conduct forensic fundamental analysis on stocks in a very rapid amount of time. That's very, very much the design ethic of the stock reports. And I'm going to talk to you about a range of indicators on the stock reports. I haven't done a webinar like this in quite a long time. And actually the first time I did it, it was very, very popular. But I've put some more materials together. I've been not 100% in the last week, but I'm feeling much better today. But I hope that I'm going to give you a really good bang for your time. Thanks for joining me live. There's a lot of you on the call live. I think we're almost up to 400 now. We had at least another 1,000 people who want to watch the replay. So that's really exciting. Lots of demand on this. Stock reports are, of course, the most popular feature on the Stockopedia site. So it's no doubt that's one of the reasons there's so many of you. It's amazing seeing where everyone's from. I mean, you're all coming in from South Africa, Lancashire, Scotland. I was born in Scotland, if you didn't know. And Malaysia. It's fantastic seeing how people are all over the world. So great to have you all on the call. Right, listen, I'm going to share my slides, which are going to be right here. Hang on a minute. Hopefully you can see me, hear me, and see the slides at the same time. If you're having any problems, let me know, but I'm going to presume that you can see it. Right, so cracking straight on, I always have to do this. Quick disclaimer before we get started. We'll be talking about a lot of data. I'll be talking about the stock reports. Nothing in here is investment advice. As you know, Stockopedia gives you education, data, tools. It's all for self-directed private investors. I think we're all grown-ups. If you do need an advisor, please do go and find one. I always tell my support staff we can't give financial advice, but we can help give education and context of the data. So you'll be seeing some historic returns. The future may rhyme with the past, but it doesn't always. And past performance, not a guide to the future, etc., etc. So just obviously got to get that out of the way. Right. I'm hoping that, yes, a quick question. This will be on YouTube after, so we will have a recording up and we'll send it out to everybody on the call. It's only subscribers on the call. There's nobody here who isn't a subscriber. So this is actually purely educational. All my enthusiasm is not salesmanship. It's actually genuine enthusiasm. And just really excited to be doing this. So I'm going to be going a little background to the stock reports, giving you a little bit of context on them. And then I'm going to go and focus on what I personally find the 7 most important things on stock reports. Going through some of the things I've done significant webinars on before, on the StockRanks, on the classification system. If you have been on one of those webinars before, these will be very short parts and not too duplicative. Also, then I'll go deeper into the traffic lights, which allow you to sort of rank and assess fundamentals of any stock against its peer group at a glance. Look at the forensic red flags, which help you sort of avoid disasters. And they've had a fantastic track record at helping people do that when they look at them. Normally people coming in from Australia now. It's fantastic. We've got lots of subscribers in Australia. I'm actually married to an Australian, so it's particularly interesting to me. I go to Sydney every couple of years. I'm going to move on to screens past, the strategies of stock passes. I'm going to go into depth on the financial history, which gives vital historical figures actually on the stock report. And I'm going to look a little bit at the sentiment and trend of the stock. I'm going to hopefully get time to talking about how to choose an approach. But after I've been through all these in depth on a stock report, I'm going to analyze certain types of stock, certainly growth stock, dividend stock, and some common traps. And then I'll go into Q&A, live requests, etc. Anyways, anyone having trouble, I'm being told you should, refresh the page at your end. I think most people are fine. I'm Ed Croft. I'm co-founder of Stockopedia. I was a wealth manager, really love stock markets. And this really whole thing started as a hobby project, and it's got a bit out of control. So anyway, really, really love it. And I'm really, really excited that, the enthusiasm I've got for this is shared by so many people. So going straight on, I don't want to spend too much time going through this, but some background to the stock reports. Now, I'm in my mid-40s, so I go back a little bit beyond when I first started investing. The internet was just getting started, but there was this lineage of old print products that I absolutely adored. And these print products tried to fit everything on a stock onto one page. And, things like value line or refs, etc. And what they did is create this really condensed format of everything you need to know on a stock to make a decision. And so really that's where the whole concept of stock reports came from. And the idea for the site was about trying to give that, similar experience, but through the browser, and hopefully give a little bit more information because you're on the web and you're not necessarily completely condensed to one page. And obviously, the design ethic from print brings quite a lot to the web. So we wanted to do something that's timely, accurate, comprehensive, presented in a really clear design, easy to use, effective metrics, and also with what the web brings to it, something very educational. So on a stock report, and I might as well just quickly show you, but everything is particularly, how do I switch? Like the problem with this webinar software is it's hard to switch between things. But if I go and quickly show you, a stock report, I'm sure that everyone's found this for themselves. But every single piece of data on a stock report is clickable. So if you don't know what something is, you just click it. You get a strict definition of the financial ratio, and then this great explanation. And often you'll find in the explanation some links to other places as well. So that's one of the great benefits of it being on the web, is you get this really interactive experience. So I really, really wanted to do that. And, thankfully we've been able to pretty much pull that off. And of course, everyone has more confidence, better decisions, and time saved. And this is one of the key benefits of the stock reports, is the amazing amount of time saved by using them. So a little bit on our data process, because we've got a lot of you saying you had company refs before Stockopedia. Absolutely. For those of you who don't know company refs, was a great product devised by Jim Slater, sadly no longer around. But I want to talk a little bit about a data process, because there's a heck of a lot which goes on behind the scenes that you may or may not be aware of, especially if you're a new subscriber. And we have lots and lots of new subscribers from the last year. So our primary data source is Thomson Reuters. We do get data from Financial Express and a few other sources as well. But Thomson Reuters are our primary data source, who are now, and the data part of Thomson Reuters has been spun off into a new company called Refinitiv that's backed by Blackstone. And it's actually in talks to merge with LSE. But Refinitiv employ thousands of analysts out in the UK, also across Asia and around the world, who scan, audit, and standardize financial data into their databases and make it available in their data cloud. So obviously financial data changes all the time. So throughout the day and night, we download financial statements, analyst estimate data, and on an intraday basis, price quotes and histories to our databases, where we then organize it, we clean it all up, and then we crunch over 60 million computations daily to build up this library of more than 2,000 statistics on every stock. And that's what then gets published through the stock reports in our screening database, et cetera, et cetera. Anyway, so there's a lot that goes on there. And there's if you think about it, you track it all the way back, there are so many people who actually do work to put this together, not just the people in our office, but all the way back, all the way back to the auditors and the company's own accounts. So there you go. And obviously, these are appreciated by many, many great investors. I used to work in the city. I know a lot of people, friends who rely on this for their personal investing. We've had great reviews from, people like David Stevenson. And it's lovely to get that third party validation of what you're doing. David Stevenson called them the stock reports, gloriously designed. Individual company pages are an absolute delight, incredibly easy to read, huge range of valuation metrics, powerful professional grade measures. And that is the key. I worked in the city for a considerable time, and when I became a private investor, I just felt absolutely blind, didn't have access to what I wanted and needed. And, this is something that's come out of it. That's enough background. I want to then go on to the 7 key areas that for me are most important on a stock report. I'm going to, after this is going to be slides, but it actually has lots of call outs and screenshots from the stock reports. So I'm going to be actually showing you a few live reviews of stocks after this, and I'm happy to take requests. I'm just actually a question by Mark Bell. Is the stock data updated continually overnight? So yeah, just on our process, we basically, we update all our fundamental data through basically once a day. The quotes can come in intraday, but we don't. We've rebuilt our data system, but it's not yet live. We're hoping to get to the point where we can actually publish intraday financial ratios, which will be a huge step forwards. So if a stock collapses 30% in the day, you would get an updated PE ratio intraday. So anyway, look out for that. Now, let me go through this 7 things. The first thing, and I know a lot of you are very familiar with the StockRanks. I'm not in this webinar going to talk about how they're composed. I'm going to talk to you more generally about them. If you do want to learn more about the StockRanks, we have lots and lots of information on them in the Learn section on the site, and also in webinars. I highly recommend the 5-year webinar I did last year, because that's got probably the most depth of material that I've done on them. But in essence, they are the 4 numbers in the top right. You can't really miss them. Quality, value, momentum, and a blended composite of all 3 called the stock rank. Now, these are based on all the other work we do, and every stock is ranked against all the others for these 3, really the 3 most important and most agreed on factors or drivers of stock returns by academic finance. And if you go and dig into how we've composed them, go and read all the docs, etc., watch the videos, you'll find that they're based on a lot of very, very proven academic measures. And based on decades of findings by legendary academic professors. So I think they're super powerful, and they're very based on all the clean sort of data that we try and generate. And that's one of the reasons they've proven so effective in so many markets around the world. One of the questions I often get is, before I say this, actually, it's important to understand these are ranked as percentiles from 0 to 100. Don't make the mistake that one of my staff once made. We ran an internal competition, stock picking competition amongst staff here. And he found a stock that was ranked 1. And he bought his portfolio was all stocks ranked 1. Now, percentile rank in the other direction. So 100 is best. So green and 100 would be best, 0 and red would be worst. He didn't, unfortunately, have a very good outcome and failed to win the competition when he bought the 1 ranked stocks. Anyway, so we've color coded these so that when you see them up in the sort of top 20, 40% or so, you will see them in green, and in the bottom 0, 25, you see them in red or amber. And the important thing to also know is if there's been a recent move of 5 or more in the last 30 days, you'll see a little arrow, a little green or red up or down arrow, which is quite useful. Now, something people often say to me, who are a bit more novice, they say, there's a stock, none of the 3 ranks rank above 90, none of the QVM ranks rank above 90, but the stock rank itself is over 90. How is that at all possible? Well, it's not, the stock rank is not an average of the 3 ranks. It's actually, we take the sum of the 3 basic ranks for every stock in the market, and then we re-rank the outcomes. So the stock rank is a genuine percentile itself. So you can think of this like if something is in the 90s, it's in the top 10% ranked of the market. So a very, very easy number to understand, as long as you can understand a percent, which most people can. Right. The other thing, the innovation we've added on the new version of the site is the stock rank history, which is right here. And this gives you, this is a very recent listing, the train line. which actually, to be honest, I use their app all the time. But the train line is only recently listed, and you can see the rank is quite low, often starts low for new listings. But the history is right here, and I'll show you how useful that is a little bit later as you sort of click back in time. But it's a particularly useful innovation on the new site. If you are still using the old version of Stockopedia, you really should switch over and use the new one. It's really fantastic. All our development is going into it. It's improving all the time, and it's already beyond the old site in so many regards. All you've got to go is go to stockopedia.com/opt-in and switch over. I'm only presenting the new version of the site, so just be aware of that. Of course, the StockRanks, this is the UK performance. This is a little bit old, a few months old, this slide, back to probably the end of April, but and the next two are as well. But they've had a fantastic performance. The top 90 plus ranked shares have tended to significantly outperform the market, and the low ranked shares have tended to significantly underperform the market. We've seen, as you can see over here on the right, and this bar chart with performance on the left axis, 90 to 100 ranked shares have done almost, over 15% annualized at the point of this study. And as the ranks declined, the annual performance has declined significantly. And low ranking shares have, anything below a 30 ranked share, personally, I'll never buy it. I know a lot of people do speculate down there, but it's a bit like swimming against the tide. I personally believe that you want to have those powerful factors as a tailwind, not as a headwind in your investing. And that's why I will always focus on higher ranked shares myself. It's a quick rule of thumb. And I think this slide is fantastic. It shows you the hit rate of picking a winner, like a stock which actually goes up on a 12-month basis in each of those buckets. And it's an almost linear decline of the percentage of winners as the stock rank declines. So you can see 90 to 100 ranked shares, in fact, anything above 70, on an annual basis since we launched them, this is the UK set, have on an almost 2-to-1 basis generated a winner. It doesn't mean you can't select a winner in these parts of the market, but I'm sorry, it doesn't mean you can't pick a loser. In fact, you've got a kind of more than a 1 in 3 chance of picking a loser. But this means the odds are in your favor. And on the other side, you've got the complete opposite. So masses more losers amongst low-ranking shares. And I've got plenty to talk about on this point. I mean, Burford Capital is a kind of recent example. I know a lot of people have been hurting, and especially a lot of subscribers. Fantastic story of a stock. And I'll talk about it a little bit more later. But these are very, very powerful statistics. So moving on to the second thing, let me talk about classifications. Now, I know a lot of you are asking questions, and I keep getting distracted. When you see me look this way, it means I'm looking at your questions. A few of you are asking for dividend dates. Just to let you know, our development cycle works in 2-week cycles. So we've got a new cycle starting next Monday, and we're significantly upgrading the discussion area. So we're adding a lot of new commenting facilities, etc. And then after that, we're going back to do another big push on StockReports. So there's a lot of new stuff coming into StockReports in that cycle. So there's a continual improvement of the site that's happening all the time. We've got some more portfolio upgrades this week, et cetera, et cetera. Anyway, understanding precisely the type of stock you're dealing with in just a few words. The classifications are right there, bang under the price quote, and you'll see 4 of them. And it's the sector, the risk rating, the size group, and the stock rank style. So I love this because it gives you an instant understanding of the type of stock you're dealing with. And it's especially useful, firstly, for a quick check on what the heck it is. Secondly, it's particularly useful when you're structuring a portfolio. So, if you find your portfolio is entirely full of cyclicals, do you really want to buy another one? If you're worried about a recession, if you've only got large caps, shouldn't you think about perhaps a small cap for a bit more, maybe hopefully a bit more profit, but at least a bit more entertainment value. And also the risk rating, which is so powerful, if you've only got speculative shares, find some more low risk shares to buy, because it's a bit like having spine in your portfolio. So I use these both for this quick sense check on what a stock is, but also from a portfolio diversification background. Anyway, going into them in a little bit more detail. Firstly, the sectors. We have 10 sectors which are broadly categorized in 3 super sectors: cyclicals, defensives, sensitives. And each of these 10 sectors are spread across them. Now, cyclicals have a tendency to sort of move more with the more major economy. I mean, we've seen plenty of financial crashes in our time, and we know how cyclical the financial sector can be. But obviously, larger purchases in consumer cyclicals, cars, fridges, et cetera, can be cyclical as well, because they're more based on discretionary spending. When people are more flush with cash, they'll buy more of those things. And that's sometimes why you see, things like auto loan companies and stuff like rocketing up in certain environments. Defensives often tend to rise less than cyclicals in bull markets, but often tend to fall less in bear markets. So, and in defensives, consumer defensives, you can find, things like, food and beverage stocks, food retail, etc. And you'll also find a lot of brands in there, which can be pretty robust. And in healthcare, obviously, you've got sort of drugs and pharma, which everyone needs to stay alive, but also a lot of very, very speculative biotech stocks. So just because you're buying a healthcare stock does not necessarily mean it's defensive, although the super sector is classified as defensive. There can be, at the more speculative end of the market, a heck of a lot of volatility across all of these super sectors. I think one of the interesting things about sectors that I look at, if I'm buying long-term, aiming for like long-term compounders, to select long-term compounders, there are some sectors you might prefer more than others. Often amongst brands, and we'll talk a little bit about competitive advantage later, but in some of these sectors like consumer defensives, healthcare, industrials, technology, you can often find far more capacity for long-term growth than, for example, in utilities, etc. So, having an understanding and, trying to read up a little bit about the different sectors is always very, very helpful. Hang on a minute. You're all asking me for so many feature requests, and I'm going to try and stay on my flow, and I'll do Q&A later. So if you can, try and keep your questions to anything I'm actually talking about at the moment, rather than something a bit more skewed, because I can answer the more skewed questions later. On the risk ratings, right. I did a big webinar on this previously, and I probably should do another one because I think these are fantastic. And they're a little bit hidden away in this one word right here, but they're backed by absolute masses of research, of insight data, etc. This is a 5-level classification based on every stock's annualized volatility. Now, that literally is the annualized share price volatility of the stock. We make a bunch of assumptions and adjustments. So if a company's a new listing, if it's only trades very rarely, etc., etc. But generally, you will find that stocks below an annual volatility of 25% in their share price will be classified as about conservative. 25 to 35% volatility will be called balanced. Adventurous is more like 35 to 45% volatility. And speculative is 45% plus. Highly speculative is like crazy. I often think one of the best ways to think about this is like the tortoise and the hare. So highly speculative and speculative shares have a tendency to rocket up and rocket down. And I'll show you some of them later. And you can get rich quite quickly in speculative shares. You can get poor very quickly too. Whereas, as we all know, the tortoise and the hare, the tortoise wins in the end. And more conservative, balanced, lower volatility shares have been proven, and we've proven it too with our data, have a tendency to beat the rest of the market. They fall less in bear markets, they go up less in bull markets, but over the long run, they win. So it really is a tortoise and the hare situation. And it's very, very important to have a good grasp on it. And I love the classification, because really reading a word is much more simple than trying to assess what relative volatility of 25% means. And because there's so many micro caps in the market, you find there's a much larger proportion of highly speculative shares. And we've actually split the market like this: 10% in conservative, 15% balanced, 20% adventurous, etc., all adding up to 100%. Go and look in the guide in the learn section. Go and look at the webinars I've done and videos, etc. Now, size group. Have you ever compared the performance just within the risk ratings? Yes, we have. You will find, if you go and click through on the learn section and you go to ranks and ratings, you will be able to find some of the performance studies we've done on this. We do actually do performance studies on this very regularly. The last one we did was April, and I'm hoping at some point we'll get it into the interface so that you can browse them yourself. But certainly it's all about risk on, risk off environments. If we're in a risk on environment, it's quite good being in speculative shares. If you're in a risk off environment, you don't want to be anywhere near them. That's the rule of thumb. Large size group, pretty straightforward. I'm not going to spend too much time on this. It's a 4-level classification: large cap, mid cap, small cap, micro cap. And we use certain hard cutoffs here, not percentage cutoffs. And you can see, basically large caps effectively map quite closely to things like the FTSE 100, the ASX 50 in Australia, BSE 100, India, and the mid cap actually maps pretty well to mid cap indices too. So it's quite a good rule of thumb. We've done it like that. People use different terminology around the world, and in the UK, small cap investors, think of even 10, 20 million market cap stocks as small caps. I call them micro caps. They're smaller, more risky than the small cap segment of the market. And obviously in America, they call large caps way bigger than 2.5 billion market cap plus. So there you go. Anyway, you can also sense check this quick phrase with the size metrics here. And I wanted to just dwell on this for a moment because there's quite a lot of people who don't know what enterprise value is. So the market cap is quite well understood by investors, and I'm not going to teach everyone absolute basics in this seminar, but it's the market value of the equity. So all the shares times the shares in issue, all the shares times the share price, you get the market capitalization. There are a few adjustments in there, etc., but that's pretty much it. The enterprise value adds the net debt to the market cap. So it's a much better indicator of the real size of the enterprise. You think about it, a stock will have all its equity and then it will borrow money on top of it. So the enterprise value gives you all of that, netting out any cash balances. So in a quick flash, you can see if the enterprise value is significantly bigger than the market cap, you can see how much net debt they've got. So actually, the top of the stock report is giving you quite a lot of information. Also, there's a sales value there. So, lots of useful information in there. And the position in market just shows the relative size of the company against the rest of the market. So if it's first, it means it's the biggest in the market. Moving on to the StockRanks styles. Now, if anyone was on our launch webinar for the styles and the risk ratings, which you can still see on YouTube, you'll know how excited I was about this back then. Still just as excited about it right now. I think this is a most fantastic innovation there is for quickly classifying shares. I really can't stand classification systems which are, classify stocks as, growth or value, or, growth and income. It's such a simplification of the reality of the different types of stocks. And Peter Lynch wrote about, and so did Jim Slater, lots of these different classifications of shares that you could make money in as a fund manager or a private investor. And we've taken this idea and we put it on steroids, but backed it up with the StockRanks. I'll explain how they're composed in a minute, but there are 4 winning styles which are labeled in green: super stocks, high flyers, turnarounds, and contrarians. And losing styles are value traps, momentum traps, falling stars, and sucker stocks. Again, you can go and learn loads more about this in other materials, but rule of thumb is to say that the winning styles have historically outperformed, the losing styles have historically underperformed. Now, we take about a third of the market and we give them winning styles, a third of the market and give them losing styles, and there's about a third of the market which is unclassified. So it's quite common for someone to say, I've got this 83 ranked stock, and it's classified as style neutral. Surely it should be a winning style. Now, that's a slight misunderstanding of what these styles mean. And they're mapped out in this schematic here, which I like to call the I Ching of the stock market. How often are these titles changed per share? They're recalculated every single day. And so if something is on the margin, it might flip from one style to the next. I'm not going to go into the maths of this because we've done some pretty canny work on it to give quite stable classifications. And but generally, the way you should understand these classifications is that if a stock, you can see on this schematic, each one of these little cards has a Q, V, and M, quality, value, momentum. And the Q, the V, and the M will either be green or red. In other words, high rank or low rank. And so you get these 8 combinations of these 3 factors. And the 4 above in this green section have at least 2 of 3 ranks, which are fairly good, and a maximum of 1, which is bad. Whereas for the losing styles, like a sucker stock, you have all 3 being bad. And for the other ones, you have 1, which is good. And that's where the trap nature comes from. So a value trap, taking one example, is a stock that's clearly very, very, very cheap, but it's got poor quality, poor momentum. And, I like to say, and personally in my own investing, I only buy shares that have at least 2 of the 3 ranks strong. And that's get me out of so much trouble in my investing. And it's also a rule of thumb for selling as well that I use. It's a very classic, because so many people have been brought up on value investing to think when something's super cheap, well, if you know that cheap stocks tend to outperform, it's very easy just to go and buy it. But, ultimately, lack of profitability, lack of momentum can kill you. Same thing happens for momentum traps, which are glamour stocks. They kind of fly up and then, they go up into the atmosphere and there's nothing up there and they just crash back down again. The great investors often focus on turnarounds, on high flyers or growth stocks. You might call these growth stocks, high quality, high momentum stocks that are on a premium valuation, tend to be all the glamorous shares in the market in this bucket. And contrarian stocks, often big investors who invest in value, and they want to buy good shares which are on a temporary decline. So very, very, very powerful stuff. Again, if you look at the win rate or the hit rate of each style, you see this sort of gradual decline. Now, more likely to find a winner in a winning style share and more likely to find a loser in a losing style. This is the unclassified segment here. And by the way, these slides, I'm going to ask, I think Sam's on the call. He's got a copy of these slides. So if you hang around till later, we'll distribute them to you so that you can go through them at your own pace. I should have said that earlier. Please do, and if Sam, you can share them now or later as you wish, but we will get them out to you. We'll put them on SlideShare or something like that. You can see the unclassified segment here actually does quite well, almost as well as some of the winning styles. And that's because actually you do find there's a lot of pretty good companies in that bucket. And as I said, because there's a third of the market unclassified, third in winning styles, third in losing styles, you can find a lot of good companies there. So don't think just because something doesn't have a winning style, it's not a reasonable investment, because it may well be. That's enough on that. So I'm hoping for those of you who've been through any of my long webinars on StockRanks, styles, things like that, that was brief enough for you to get to this point. So I want to talk a little bit more about some of our financial data, which obviously goes into all the rankings and the classifications, and talk a little bit more about it. So you'll see here some of the key financial ratios above the fold. There's more below the fold of the page, but I want to focus on these just for now. And to the right of it, you'll see these little meters, which are green or red or amber. They're RAG rated, and I like to call them the traffic lights. And these that you basically take a financial ratio, for example, the PE ratio, and I'm going to presume most of you know what a PE ratio is, the price earnings ratio. I'll go into more detail on some of these metrics, probably another time, or if I have time at the end. But the price earnings ratio being the most popular valuation ratio. And that's, for this one, Trainline is on a 48 PE. How do you know if that's high if it's good or bad, and it's very, very hard to know, especially if you don't know the range of the market, PE ratios, etc. So the traffic lights give you a quick visual indication of the relative ranking of shares ratio against its peer group. If a ratio is good, for example, if it's a PE ratio is cheap, this will be wide and green. If it's average, it'll be amber. If it's expensive, just like this one is, it's very thin and red. So you get this quick, you get this very, very quick sort of visual indication of basically a stock's key fundamentals. And I think that's just fantastic. Very much, very, very, very useful. And also they're ranked against the industry of the stock and the market as a whole. So that's why we give two of them. So you've got the industry here and the market. And if you hover over them, you will get, so if you like hover over one, you get this little pop-up, which will show you actually how it ranks against everything in that industry. And that's an ordinal rank. So it's, if it's bad, it'll be 48th out of 49. I know people sometimes get a little bit caught out on the difference between ordinal and percentile ranks, but anyway, that's the way it works. So I think you can agree these are particularly useful. I will look at a stock, and like if I'm looking at this, let's say this is the train line, I'm very, very quickly scanning, and I can go, okay, wow, blazing growth projected, but really expensive. These evaluation ratios really expensive. And I got to say, they could do a little bit more in terms of their historic profitability. But maybe the growth is going to make up for it, because this is the earnings per share growth. And I'll look at that. And I've got a very, very quick sense check of the stock. And at the moment, because the quality ratings are quite poor, this is why it's a momentum trap. Because I said this has got great momentum, but poor quality metrics, poor value because it's expensive. So only one green indicator there, and that's why it comes through as a momentum trap. So you can very, very quickly get this sense check of the kind of stock you're dealing with. Now, if it becomes really profitable in the future, the quality will go up, and maybe it'll look like a high flyer and become a market darling. And that's how I will generally sort of look at these. That's how I will look at these stocks. Now, I want to go in a little bit more detail here, because when you use financial data, and if you use financial data from any kind of free or public source, there's a reason why it's probably rubbish. And I'm not going to pull my punches on this, because I really fundamentally believe in what we're doing at Stockopedia, and we care about data. Now, free data is not worth investing on, because normally, if it's free, they're advertising on the site, and that means you're not really the real customer. You're the product sold to the customer. So I want to focus on why our data. One of the reasons our data is better, apart from all the cleaning and work that we do on it, it's also how we standardize it so you can compare stocks like for like. So for forecast ratios, and in this segment, these are the forecast ratios, we standardize them as a rolling 1-year forecasts. So when you compare companies, it's vital to compare the exact same time period. Now, you imagine you've got one stock which has a year end at the end of March, and another one which has a year end at the end of December, and you use the forecast PE ratio from some random source to compare them. You can't. So what we do is we calculate what's called a rolling forecast, which shows every company on a 1-year rolling ahead basis, blending the first and second year of forecast data into a standard measure. This allows like-for-like comparison. Now, here's a very basic breakdown. Imagine you've got a timeline here, and I put the wrong dates on this, but end 2018 there, 2019, 2020, 2021. Imagine it's 3/4 of the way through 2018. Now, if you had two companies, you're comparing them, and one is reporting here and one's reporting there, you can start seeing that you're not comparing the right figures. What I will do, and to calculate rolling data, is we'll look 1 year ahead, and we will take part of this year's forecast from the broker. So let's say there's a 20 pence forecast on the earnings per share, and we'll take 3/4 of the next year's forecast to create a blended measure of 27.5p on a rolling 1 year ahead basis. Quarter of that, 3/4 of that gives you 27.5p. So then you can compare the share price and spit out a genuinely more accurate PE ratio of 10.9. So when you're looking at our price earnings ratios or our forecast growth rates, this is what we're doing behind the scenes, as long as there's broker estimates. So, it doesn't matter when a company is reporting, as long as it's got the next 2 years forecasts, they're all compared like for like. And that's very, very powerful. And it does lead to better results for investors. But we also do the same thing on our trailing ratios. Most companies are most published data will give you a PE ratio, which is historic. And again, it would be in the last trading year. And of course, if the company's 350 days through its year, it's not much use knowing what the earnings were nearly 12 months ago, because you're nearly rolled on to the forecast. And also, they may have reported quarterly or interim data since. Now, value investors like to look backwards. They don't like focusing on broker estimate data because it can be unreliable. And they'll always use historic data. So we calculate what's called the trailing 12-month data. And that will sweep up all of the half-year or interim and quarterly reports since a company reported its annuals to create a trailing 12-month period for things like price to sales ratio, etc. And for any balance sheet indicators, we use the most recent quarter, because that's all point-in-time data. But it's very important. And again, I've done a timeline to illustrate this. So the current date, if the current date's here, you would look I've managed to put the wrong dates on there. And I'll get them cleaned up. But imagine the current date's there and there's a year ago here. And the year-end date is there. A historic ratio of price to sales or something like that, price to earnings, would be missing all the quarters and half-year reports which have happened since. So we'll sweep all of those up into a much, much more accurate historic measure. So that's, again, one of the reasons why our data will be much, much better than you'll find in sort of more free sources and things like that. And people often write in and go, why is your data different to X? And after you audit the data, you tend to find that we are the ones that are accurate and the free sources are not. So, do bear that in mind. Right, I want to go into the red flags bit because I think this is absolutely fantastic. Just going to have a sip of water. Now, these red flags have saved investors from disaster stocks time and time and time again. And I'm really proud of them as an innovation on the site. So here we go. You'll find them as you scroll down the page next to the financial summary, this little block here, health trend, bankruptcy risk, earnings manipulation risk. And each of these is super powerful. Firstly, the fundamental trend or the fundamental health trend. We've tried to make it a little bit more sort of understandable by calling it the health trend. But this is based on Joseph Piotrowski's F-score. Now, Joseph Piotrowski, as you can see down here, he's an American professor of accounting at Stanford. And he wrote this really seminal paper in 2002 called The Use of Historical Financial Statements Data to Separate Winners from Losers. And effectively, he was fascinated by deep value investing. He wanted to find out, value investing, as most of us will know, if you buy cheap stocks, you tend to beat the market. But in that basket of cheap stocks, there are a lot of duds. Things can go bust. There can be broken business models, value traps, like I spoke about earlier. And he wanted to find a way to separate them, sieve them. So he came up with this thing called the F-score. Now, on the site, if you click the F-score, you will get a pop-up with all the different 9 checkpoints that he checks on accounts. But essentially, they cover profitability and cash flow, and then improvements in profitability, improvements in leverage, so debt coming down, liquidity, ability to pay short-term debts, going up, and funding. Also looking at improvements in operating efficiency. Now, all of these measures, they kind of are very hard for a lay investor to spot when they just read the news, because when you read the news, you just go, profits are up, yay, buy. That's a pretty naive way of looking at a stock. And people often won't go and dig into the company accounts. And if they do, they rarely compare them with the previous year. So this is a very, very fast way of checking on a trailing 12-month basis whether fundamentals are getting better or not. So 7 of the 9 items actually look at the difference from the previous year to the current year. So that's one of the reasons it's so effective. And it's actually about a third of the overall quality rank on Stockopedia comes from this one score, because it's actually time and again proven very predictive in the market. The next one down is the bankruptcy risk score. And the bankruptcy risk score is based on Edward Altman's Z score. And he created this sort of acclaimed, I think it was in 1972 he came up with this. And it's a combination of 5 weighted business ratios, and it estimates the likelihood of financial distress. It's not showing here on Trainline because I think it's a new listing, but generally it will show for all stocks except financials. We're going to work on something else for financials. But in its initial test, it was found to be 72% accurate in predicting bankruptcy 2 years prior to the event. And we've taken what was a pretty hard to use number, and we've slotted it into a meter which has a black arrow on it to show you if a company's in the distress zone, cautious zone, or safe zone. And I just think it's so cool because at a glance, without having to go and dig deeply into the financial statements, you get a very, very quick sense check on, the riskiness in terms of financial distress. And I will also often look at this, and I'll then look below and look at the gearing ratios. Now, gearing is a bit of an old-fashioned British term, but these are debt to equity ratios. This is the debt to equity ratio here, and generally, I would like to try and avoid companies that have too much gearing or too much debt compared to their equity, because it just creates a lot more risk. Anything above 50%, you might want to have a little bit more of a think about. And so looking at the leverage there is always a good sense check too, especially in comparison with the bankruptcy risk. But again, click the Z score and you'll see some of those items broken out into a checklist. And this has kept quite a lot of people out of trouble. Next one is the earnings manipulation risk. And I keep getting more excited as I go through this, but I absolutely love this indicator. The M score is created by Messer Daniel Benesh, and he, again, another professor, and this is a very celebrated paper he wrote on this, and it really is a mathematical model that uses 8 ratios to identify whether a company is managed or manipulated its earnings. And this is what is really powerful, because he found he could correctly identify 76% of manipulators with this score, but only incorrectly identify 17.5% of non-manipulators. And think about that, because I know a lot of people, they will buy shares that have a high earnings manipulation risk. A classic example is Burford Capital. Burford Capital was flagging with a high earnings manipulation risk. I know it's yet to be proven. I know if those of you who are international, it's been a bit of a scandal in the UK around Burford Capital. It's a massive glamour stock. So many subscribers and private investors in the UK owned it and had done amazingly well over the last few years. But the ranking deteriorated, and there was a big short selling report done by one of the big, I think it was Muddy Waters, the US blogger and short seller, and the stock collapsed. Well, we did have it flagging with a very, very big red flag here. And, it's always worth bearing it in mind. I find generally that growth stocks are more prevalent to show a risk factor here, because sometimes that can balloon things like the receivables and so forth. And growth consumes a lot of capital. But also growth puts a lot of pressure on sales teams to deliver and can lead to more aggressive accounting processes. So again, if you click that M-score link, you'll get a big checklist of all the risk factors that go into it. And it's been effective time and time again. So leave that with you. Those 3 indicators I think are super powerful: the F-score, Z-score, and M-score. But also they look at stocks from very different angles, and they provide a bit more of a holistic set of red flags. Anyway, from there, someone's asked me about consensus trend of the brokers. That's 0.7 in this. Let me have a little look. I'm on 0.5. It goes to 0.7. So screens passed. This is, for those of you who don't know, these are all based on what we call our guru screens. So up here, top left, you go into the browse section and you will find all kinds of Stockopedia rating screens. You'll find guru strategies too, and I'll show you on the site a little bit later. But we effectively take 65 guru strategies. I've got tons of books in the bookshelf here, all the classics of financial literature on stock markets. And we took 65 of them and we modeled them. Strategies written by Ben Graham, Jim Slater, Naked Trader, strategies about Warren Buffett. I mean, all these legends of investing. And we created these pre-rolled stock screens that you can go and browse and review. And we tag the stocks every night that qualify for these all around the world. And we publish them in this little widget on StockReports. And it is above the fold, just under the chart right there. And in that little widget, you'll be able to go and click left and right and see which strategies it qualifies for. And you can click through to view the screen itself, where you get more context. But also you can click through and see a checklist about that screen as well. So it's powerful stuff. I personally like to see on shares I'm buying that a stock also qualifies for one or more guru screens, because it just means that more investors might be looking at it. You know, I know if it qualifies, for example, for a Zulu Principle screen, I know Slater Investments might be looking at it, who use that sort of strategy. If it's got lots of dividend screens there, might have a lot of dividend investors looking for it. It's going to be on the radar for dividend funds. So you like to know there's a bit of a weight of capital behind your purchase, and I think this sometimes backs it up. Beware short screens. They are negative screens that indicate something may be wrong with the stock. They often mirror or back up the red flags. And that's really all I want to say about that. You can explore them in your own time. So next, 6 out of 7 points, the financial history. Now, this is all about using the history of a stock to predict its future. And learning to read the financial history will give you so many benefits. If you don't already do this, please do start. The financial summary is in this block, and it's been designed with the key financials in mind, which can give you a very, very quick sense check of where this company's been and where it's going. So we've got 6 years history, a couple of years forecast, and the compound annual growth rate, or the average, depending on which type of metric it is. And as you hover over them, you get these little pop-up charts. I'll show you it live when I'm going to go onto the site. But there are a few things I like to look at, apart from revenue, profit, net profit, earnings per share. I want to see that all these are going up and to the right and growing, obviously. But I want to focus a little bit on my talk here about some of these metrics down here, because they're things that often people don't look at. So profitability. I like checking for high, stable profitability in shares that I buy. It's just so important. And especially if you're a kind of long-term investor, you want to... A lot of people I know, and especially on this call, are interested in holding stocks for the long term. And if you're a long-term investor, you've got to be looking at the long-term profitability. Firstly, on the margins, operating margins, that's the operating profit divided by the sales. It very much shows the kind of efficiency of the operation in creating profit from the sales. It's industry specific. So comparing operating margins across different companies in different sectors is not very doable. But if you're looking at, for example, all the retailers, you might want to, you can look at margins across similar retailers. Because let's say a company that does like one sale a year versus a company that sells something every minute, they have a very, very different velocity of assets. So you might find that retailers are quite low margin businesses, but they can still generate high returns on their capital because they have such a volume of sales. So that's why we have these return on assets, return on capital employed, return on equity. Personally, I like focusing on the return on capital employed and the return on equity. Return on capital employed is literally that. It measures the percentage profit made on every unit of capital employed in the company. That includes equity and debt. Stocks that generate 20% plus returns on capital may have a rare competitive advantage. So whereas if it's lumpy and it jumps, and one year it's 50%, the other year it's minus 50%, this is a pretty dicey kind of stock, and they might not have a consistent return source. I like to think of the return on capital employed as a real sort of compounding engine in a business. It really shows that if you're going to raise more money and put it in, that's the kind of if it's got a consistent 20% plus return on capital, that's the kind of return that you can get on that capital. If you retain profits, it acts as an accelerator. And that brings me to the return on equity, which is just more interesting for shareholders in some ways. It measures the percent profit made on every unit of equity invested in the company. So if you imagine a company can retain earnings, and it doesn't pay it all out as dividends, and you retain sort of the profit back into the company, well, the return on equity shows that you can retain it at a certain rate. And that's very, very powerful. And again, why, if you want a compounding stock, these are the kind of profit engines. But of course, high returns invite competition. High margins invite competition. High returns on capital invite competition. Only companies with a genuinely sustainable competitive advantage or moat can defend them. I've got a slide on moats in a minute, so I'll come back to that point. The other thing I like to check is cash flow. I like to see that cash flow is flowing freely. The very best investments are cash cows. And also, earnings can be manipulated. People that buy stocks just because of the earnings and don't pay attention to the cash flow can get in trouble, because earnings can be fudged, and they regularly are. It's amazing how regularly they are. It's not illegal to fudge earnings. There are lots of accounting sort of tricks to sort of massage earnings a little bit, because you might, a lot of companies, especially in America, that have to report quarterly, find that they're always under pressure to hit their numbers, and that can create creative accounting. Normally, you'll find in the next period, if someone books sales early, they might actually, they'll sweep it all up in the next quarter. But if there's a culture of massaging earnings, that's pretty negative. And one of the easiest ways to look for this is just to look at the cash flow. I like to see that operating cash flow is at or above normalized EPS, because it just shows me that they're converting profits to cash, and cash is the lifeblood of any business. It's used to pay down debt, pay dividends, buy back shares, make capital investments. And that's the capital investments or capital expenditure is broken out in this line. That's investments in, if there's a retailer, there might be refurbing stores, in plant and equipment, hard actual investments tend to come out of operating cash flow. And after that, you get your free cash flow per share. And free cash flow per share is particularly interesting because you can use that in some of these other ways for dividends, etc. As an investor, that's what you're really most interested in. You want to get cash flow. So seek companies where the majority of EPS is converted into free cash flow per share. Be kind of cautious around stocks with really lumpy capex, because you never know when the next lumpy capex is around the corner. Just thinking of a stock as a real business is a good way to think about these things. Hang on a minute. Assessing the dividend history. I am getting some questions. I will try and get through them a little bit later. Dividend investors, and I know a lot of you on this call are dividend investors, and everyone likes to get income from the stock market. There are lots of good yields on offer, and this little segment is very, very powerful. And if you are a dividend investor, do read those other bits all the time. Look at profitability, look at cash flow. They're important for dividend investors, and use the red flags. They're all key things for a safe dividend. Dividend investors should look for a consistently growing dividend. We have written a book on this. I don't know if I haven't prepared this, but it suddenly triggered my thought that we do have a book we wrote a few years ago about dividends. I think if anyone is the staff are listening, if you could post a link to the book, I think it's book/dividend-stocks, but have a look there, because it talks all about some of the factors that really are great for dividend investors, and it's all about yield, safety, and growth. And dividend growth is something which tends to be something that a company actually kind of mandates at board level. So they'll actually stick to a dividend policy, and they'll pretty much agree that they will stably increase their dividend every single year. I mean, this one here, I can't remember where I pulled this one from, but you can see dividend growth here was very strong, and then they flatlined for a few years, and then it picked up again. They may have had needed to spend their cash on other things. Maybe they had capital investment to make. But you see, for dividend investors, that's quite disappointing to see 3 flat years in a row of dividends. And if a dividend cut is when it drops. So you don't ever want to see dividend cuts in the history of a dividend share, ideally. In fact, there are some dividend aristocrats that have paid dividends for 20 years and grown dividends for 20 years, even through bear markets. And that's a pretty amazing thing for a company. You also want to look at the cover. For a lot of international investors, I know in America they prefer what's called the payout ratio, but really dividend cover is all about comparing the earnings against the dividends paid out. So this shows you how much the dividend payment is covered by earnings. So as it's around 2.7 all the time, it means profit's kind of 2.7 times the dividend payout. That's a really, really important measure. Anything that gets down to cover of a dividend cover of 1 or less may well indicate a future dividend cut could be coming. And if there are other red flags and you're worried about the dividend cover, you might want to think about moving to a better prospect. So I just think that's a really valuable bit of kit for dividend investors. And the other thing that a lot of people don't check very often, that I check all the time, is this little line down the bottom that shows you the diluted weighted average shares. And this is actually from Next PLC, which is a really great, and has been a very well-managed retailer over many, many years. And they've had a significant buyback scheme in the UK. And as you can see, if you hover over this line, you can see the number of shares has fallen over time. So they're buying back so many shares. They've actually reduced from 5 or 6 years ago, the number of shares in issue from 156 million to 136 million. That's 3% bought back every year. And what is so important about this for an equity investor, if you're a shareholder, is that it acts as a massive accelerator on EPS. And you own a certain number of shares. The profit that matters to you is earnings per share divided by shares. So if the denominator of that calculation, the per share amount, is reduced, that means that it's more EPS for anyone who's a shareholder. So I love to see this. And if you look at some other company like massively dilutive stocks, like for some reason private investors love investing in the worst stocks in the market. I know as you're a subscriber to Stockopedia, that's not you, but if you go on any of the big bulletin boards, you find or people piling into things which are real jam tomorrow stocks. Serious Minerals is one that I've always been, very skeptical on. And you find that they serially disappoint and they serially raise more money and more equity than you can ever imagine. And that acts in the opposite direction. You see this trend going up. It's more dilutive, less future profit for you, bad for shareholders. So I always like to look at that, and I suggest you do too. Finally, and I've had I'll come back to some of those. Sentiment trend. So this is all about the broker predicting the direction of travel of any stock by analyzing the trend of analyst forecasts. And again, another thing I get excited about on StockReports is this block here. Now, there is a table here, gives you some of the more kind of straightforward data. And you can look at the next year and the year after, net profit, EPS, DPS. It's a little bit duplicative of the table above, but at least it breaks out the 1 month and 3 month change in those numbers, which I think is super good to see green in there, because it means that there are upwards revisions. If brokers are forecasting, having to up their forecast, it's a very positive sign. In fact, it's far more positive, far more useful than the absolute level of their forecasts. You also get in this block the estimated long-term growth rate, not really that valuable. Also the price target, which I often mock broker price targets, but I know a lot of people like them. But I want to focus on these measures on the right here, and I'll pick out on the consensus recommendation first of all, because a lot of people, when they get started investing, they go out and they see a stock is rated buy, and they'll go and buy it. And I think that's not the right way to think, and I've done a lot of research on it. What you tend to find, the stock market is a great discounting mechanism, and it tends to, factor in whatever it already knows. So if something's a buy recommendation, it's really not worth that much. What matters is the change in recommendation. So you can see very clearly here, although we could probably make the other one a little bit dimmer, but we show the current recommendation in the black arrow and the 3 months ago recommendation in the gray arrow. So for this stock, the recommendation is coming down. And I mean, not very significantly. And, these things can shift a little bit. When you see a big jump, that's very significant. And often a big change in recommendation will signify a significant shift in share prices. But I always think it's best to ignore the absolute value of the recommendation. It's best to focus on the change in recommendation. And this chart down here is our own research into the performance of buy recommendations. So I think these are the stronger buys in the market. These are sells and holds. And you can see that the strongest buys in the market have tended to underperform all the rest. So if you see a meter right up here on strong buy, be a little bit skeptical. It's not necessarily as good an indicator as you think. The other thing I would always say is check how many brokers are actually estimating on the stock. If it's only one, be super skeptical, because lots of small caps have only one broker. And if you've only got one broker, it means that it's probably the house broker. There may be a relationship there. It may be paid for or sponsored research, because no company likes to have no forecasts. So some things to think about. But this is one of my favorite charts on the whole stock report. It shows the change. So the change in analyst forecast, or the trend in earnings per share for the current fiscal year in dark blue, and the next fiscal year in light blue, depending on what the year end is. You can get the year end date here, but if you focus on the chart, this shows you the 2019 estimates. That shows the 2020. All I will say is up and to the right is good. Down and to the right is bad. Up and to the right, consistent trend of increased forecasts is a very, very good sign. Researchers McKnight and Todd, they looked at European stocks in 2006, and they found that the 20% of stocks with the highest net upward revisions in earnings outperformed the lowest 20% by 16% a year. Again, it's about having that tailwind behind you. You want the brokers to be ratcheting up their earnings. I mean, they're like a shoal of fish. I've got plenty of friends who are analysts, and they're fantastic analysts, but they do act a bit like a shoal of fish. Someone in that set of analysts will have really great information, and he'll often go out ahead of the pack and put his number up. And the others will sort of like not have as good relationship with the management of the company, and they'll gradually start trying to gather information to figure out why his is so good. And they all start ratcheting up. So that's why you start seeing these trends happening. And again, it's up and to the right is a good sign. And it's simple as that, really. So that was the sort of 7 things I wanted to focus on. But before I go and dig into the site a bit more, I mean, I've actually got quite a lot of slides, but I'm aware we've already been on for an hour. I want to look at I got quite a few questions when I asked you about qualitative factors. Now, as I said, I wasn't 100% last week, so I haven't been able to do as many slides as I like on this. But I've got one slide on competitive advantage. And I think there are 5 key signs of what Warren Buffett would call an economic moat. So if you're buying a stock, and you know it's got great profitability, you want to know how sustainable that profitability is. So again, like you're looking at the margins, the return on capital employed, the return on equity, and you think it's reasonably valued. If you're wanting to buy it for the long term, you want to know that it's going to sustain its competitive advantage. An example is like a Hargreaves Lansdowne in the UK, which has got very, very high profitability, but competitors are coming in. But it does have a lock-in of those customers. And the question is, how much of the switching costs is it really putting on its customers? So I'll talk about that. There's a second point here. But the first point is intangible assets. There are 5 things which give people enduring profitability. Firstly, intangible assets. That's things like brands, patents, regulatory approvals. If you manage to invent something like, if you've got like a really, really great enduring brand like Coca-Cola that people are just totally addicted to, fantastic. Tiffany's has a fantastic brand. Not all brands are great. Some do deteriorate. People get patents on drugs that can do fantastically well over very, very long periods of time. And other forms of regulatory approval in, finance, etc. These things are very, very powerful in terms of pricing power. Switching costs. Again, as I was saying, banks, financial companies, there are switching costs. I've been with the same bank since I was 13. Can't think of how much money I've probably paid them, and you just can't get off them because you've got all your direct debit set up. But also software. Software vendors can create great lock-in. You look at things like SAP, you look at Sage in the UK, companies that have software that's very hard to get off. They have pricing power, and that leads to enduring economic moat. Network effects. We all know social networks. They've all become very famous. Facebook, Instagram, which I've deleted from my phone because I was too addicted to it. But these network effects are super, super powerful. And this is why it's actually a really extreme form of switching cost. And it's not just internet companies like Facebook. You've got things like Visa, Amex, payment networks. You think about the point of sale of Visa all over the world. If you want to create your own credit card, you've got to compete with that. That's very, very hard to deliver. Look at Microsoft Docs, .docx files. There's a network. If you get a .docx file, I don't use Microsoft products, okay? And, I still have to have a way of opening them and using them. So these things are quite powerful, but they can break down over time, but they're very powerful. Companies can you analyze a stock, look for cost advantages, because they can be sustained for a long time. You might have cheaper process, better location, especially, you often see mining companies, they've got like an amazing location for a mine, and that allows them to reap outsized profits for a very long time. I know it's hard on serious minerals earlier, but it is about finding these locations. And once they eventually do get up and running, they can be extraordinarily powerful. If you think about companies that waste disposal, the regulations around new waste disposal companies, no one will allow them in their own backyard anymore. So you have these kind of these sort of locks which give you significant cost advantages. And one of the kind of powerful forms of that is greater scale. Scale is a king of cost advantages, and it's why you often see VCs pouring so much money into sort of early stage companies, because they want to get them to that scale. Distribution networks give huge scale. You think of DHL, companies like that, but also niche markets. There's a great little book called Hidden Champions, and it talks all about niche engineering firms and so forth. You can dominate in scale in a very small market, and it becomes very, very hard to compete with. So when you're looking at companies, and I know Games Workshop is something that many people have asked me to analyze, that's a company that's managed to dominate in a niche market. And they have an extraordinary niche, which actually lets them reap outsized economic profits. So anyway, that was something on those. I know I mentioned like management. Talked about sectors before. If you are looking at company management, it's always worth going and checking out the directors' dealings. Do they have skin in the game? Look for good independent governance of companies. An independent chairman, independent board. You want to look for management with a good track record of actually reaping economic profits from stocks. I would have put more together on that, but I don't really have time. Quite a lot of you asked, so hang on a minute. What I'm going to have a quick look at here, I'm going to have a quick look at some of my, just bear with me 1 minute, because I want to go on the site and start looking at a few shares. I do have some slides on when to sell and about sort of choosing a strategy, because how you look at a stock does depend on that. But I'm going to save some of these slides for a little bit later. I'll come back to this. Let me just switch around. So let me go to the website. Here we go. So I'm going to back to the Stockopedia website. Now, as I said, if you're not yet on the new version of the site, so many benefits to it. It's mobile friendly. It works on tablets really well. You can take it with you on your phone. So please do switch across. We are keeping the old site up and running for a while and a while longer. And we're continuing, but all our investments going into this new site. So all my engineers are working on it, and it's fantastic. Jerry DP saying, is there a section on Stockopedia and directors' dealings? It's going to be added in, I think, about 2 or 3 weeks. So you'll find it pretty soon in the accounts section. You'll find directors' dealings in there. So lots and lots of good stuff here. This is Games Workshop. Now, Games Workshop is a kind of example of a share which has done extremely well for subscribers. Now, this was when Sam sent out a survey to lots of you about which stocks you wanted me to have a look at. And Games Workshop was one of them, and it was the top most requested one. And this was in my NAPS portfolio, which I published on the site, I think back at the beginning of 2017, and it more than tripled over that year. But it's kept going. And, people that got into this share, and as you see down here, the stock rank, in this stock rank chart, got up to about 98, 2015. Dawdled along the shares for a good year before rocketing. So this one is like 10 bagged for investors and subscribers. So really, really great outcome. And, obviously the question on a lot of your lips, like, do you still hold? It's done really well year to date. It's still up at highs against a bad market and across any of these timeframes. As you can see, the rank has slowly started to come off. Excuse me. I had a really bad chest for the last week, and I've managed to get this far without coughing. But anyway, the things I would look at very, very quickly. I'll give you using some of the things we talked about. Quick sense check on the ranks. Stock rank 85, high quality, high momentum, poor value. If you remember the schematic, that equates to a winning style of share. 2 out of 3 of these ranks are positive, and it's a high flyer. So that classifies as a high flyer, which is amongst sort of the more glamorous stocks in the market. It's an adventurous risk rating. So it's kind of, which I know is a kind of like middling kind of volatility in the market of around kind of 35% annualized. It's a mid cap too. Thanks a lot for that comment. Anyway, so, I'm very, very quickly sense checking it. I can see it's a mid cap, the market cap's 1.5 billion. But look at this, the enterprise value, it's less than the market cap. If you remember what I said, instantly I know that this has got net cash. Because if it had net debt, the enterprise value would be bigger. So, powerful already. You can see this, it's got net cash. It's a, glamorous stock. Some things are going right here, even before I look at the quality ratings further down. So I can see that, using the chart, it's flown up. And very quickly eyeballing here, the forecast ratios, it's on a forecast P ratio of 22.2 in a year's time. It's getting very high. And looking against the industry, there's only 2 in its leisure product sector. But against the whole market, it's almost in the kind of top 10% most premium stocks in the market. So that's pretty punchy. And if it does, make any mistakes, it could get punished. But that's the nature with high flyers. You just find that they are always on premium valuations. And on all these historic valuation metrics against price to sales, against its book value, it's also punchy. The earnings per share growth that's forecast is not so great for the next 12 months, but the yield's pretty good. But investors really like it. But look at these profitability metrics. Return on capital of 75%, return on equity 70%, operating margin 30%. That's why investors are buying it. They see this economic engine, and unsurprisingly, it qualifies for a screen which is Buffett-esque. So it is a Buffett-esque stock, but it's very expensive. Now remember, these are 1-year rolling forecast ratios. So if I go down and I find that, the P ratio actually currently is 23. And that's really because there's not that much growth predicted for the next year. I don't know too much qualitatively about Games Workshop, apart from I do know, obviously they make Warhammer and all the fantastic figurines people like to paint, and they've gone digital. And that's been one of the transformations recently. But, looking at all these metrics, you can see these great, flying increasing sales, profit numbers, not anything too exciting for the next few years, but a steady growth. And you can see these great sort of historic growth figures. So that's pretty much the tail. Good health trend, bankruptcy risk is safe. M-score, that all-important manipulation figure. They're not doing anything fussy on the numbers. You can click these and you get across every measure. It's got good ratings across for its earnings quality. So I think that's fantastic. But really, it's very interesting in terms of the gearing. It's got net cash. So if I go and look down here, cash always had its positive cash balance, 30 million in the bank, and the net debt here is the complete inverse of the cash. So this is a stock that has no debt, which is pretty powerful stuff. And if you look here, earnings, weighted average shares, it's not falling, but it's only increasing at a very, very low rate. Now, that probably means that shares have only been issued as sort of management incentive, because often they might issue some options to management, etc. And so that's pretty interesting. Looking at the profitability metrics, look at how the margins have rocketed up. The return on capital, again, has rocketed up in recent years, slightly shaved off in the last year. And this is the kind of what has driven that share price increase. But look at the cash flow. I was talking about comparing normalized EPS with cash flow, and it's almost every year it's been well ahead of the EPS. And that's such a positive sign for a stock. Some CapEx, more CapEx investments recently, still lots of free cash flow. Dividend cover, not as high as I'd like it. And, they did cut the dividend a few years ago, which, would have upset a few people, but it has bounded back. So anyway, in a nutshell, you've got also the brokers ratcheting up their forecasts very, very significantly over the last 6 months or so. They've gone up from 150 up to 206. So, there's so much that's good about Games Workshop, but I think a lot of people don't know you can do this, but on the print button, it's always worth going and having a look at the past. So let's go and have a look at what the stock looked like back in 2017. Click that button and you can scroll back through time and pull up a historic report, which I'm doing like this. Hopefully this will come up in my browser. Oh, what's really annoying is it's not showing it in my, I'm gonna have to switch screens to show you this. But not everybody knows that you can do this. So here's the historic report. And I've pulled this back to looking at November 2017 when it was a 93 ranked share. But look, it was on a much, much more moderate valuation of 14.4 times earnings. The earnings per share growth was much higher, 22% projected. And still lots of kind of good quality metrics, but it just wasn't quite as expensive. And that's one of the reasons it's had sort of such a dramatic increase in price. You can see here also it qualified for one of my favorite screens, Slater Zulu screen, and it had a PEG of 0.79. So a PEG of 0.79, let me switch to my slide to explain what a PEG is. Here we go, back to my slides. I just wanted to sort of highlight this because I've always liked the PEG ratio. It's the price earnings ratio divided by the growth ratio. And it was popularized in Slater's Zulu principle and by Peter Lynch. But a good rule of thumb is that when a PEG is less than 1 and you've got a good growth stock, it's a really good sign. So, you've got to be a little bit careful with the PEG on cyclical stocks. But if you've got a genuine kind of stock that looks like a bit like Games Workshop, it's on a low PEG, good forecast growth, that's a really powerful sign for the future share price. And it's something I always like to see in growth stocks I look for. And hang on a minute, I'm going to go back to the site. And if I go back here, Games Workshop, you can see today it's on a PEG ratio of 8 times. And that's because the forecast growth rate has slumped a lot and it's on a much higher premium share price. So the valuation, for you're a growth investor, it's sort of coming down. I don't know the stock too well. From a factor perspective, there's still lots going for it. Good dividend share. And knowing what happens when brokers ratchet up their numbers, it normally means they're a bit too pessimistic on the future. And it does look like they're increasing 2021 numbers faster than 2020. So there may be more to come, but one can't expect it to continue as it did in the past. Anyway, so I'm going to, Mark is saying the mobile app doesn't include all 4 of the ratings. That's true. We cut it down to size a little bit because, you have to make some design trade-offs. But actually on the mobile, you do actually get the sector in the breadcrumbs up here. So you can always look and see the sector up here, depending on where you've come from. So look, I know I've been going for quite a long time already, but I'm gonna keep. If you want me to keep going, I'm very happy to go on because I wanted to look at like 1 or 2 kind of traps, and sort of Sirius Minerals is a good one to look at because this has been such a popular stock, and if you go on some of the brokers, okay, John's asking about ABDP. I'll just look at Sirius now. I like beating up on some shares like this. It'll probably now rocket 50 times in the next year just because I'm bringing it up. But you can see here it's got very low quality, got low value, low momentum. It's a stock rank of 8. It comes through as a speculative sucker stock. Mark, you're asking how to get the historical data up. Of course, I'll get that up again. You basically go to the print button and you click it and you just scroll back. And you can. These are all PDFs that we've stored in the past, and they go back a pretty long way. So it's pretty useful. I want to show you some other kind of great facilities on the page as well. But, you can see on here, Sirius has always had a very, very poor ranking, and it's often so loved by private investors. And I want to look at a couple of things I look at. So speculative here, this massively heart-wrenching share price movement that you get every year. A speculative risk rating is 45% annualized volatility. So you've got to expect to win or lose 50% plus in a year. And that's that's up to 70% in this bracket. So it's a very volatile share. You've got this red flag of bankruptcy risk right here. You've got, it's actually looking quite relatively inexpensive against book value at the moment. But it's got all kinds of, issues here in terms of bankruptcy risk, health trend. Obviously, everything is negative here because they're investing. I seem to remember they had some problems. They've already got like a bunch of debt, not masses, but they're borrowing. The forecast of consensus flies up and down. So it's a very, very instantly, understandably speculative share. It's very much jammed tomorrow. So these kind of shares, as I said, they're kind of 2-to-1 against on a 12-month outlook. If I was to get into a mineral stock, I want to see that it's generating profits. I like, you can still do fantastically well in companies like this when they start producing. And I've bought E&P stocks when they started generating barrels of oil, and it's often the best time to get in because there's a huge opportunity cost to sitting around for a decade while a stock gets itself into a good position. Now, I wanted to show you this because I highlighted diluted weighted average shares, and on a stock like this, it doesn't come up instantly on the rest of the numbers. But now I've told you, I hope that you all scroll down, hover over the diluted weighted average shares and look at it. Because any of these kind of really speculative shares, you're going to see these massive hikes in number of shares in issue because they constantly having to fund operations through equity issues. So worth pointing out. There's a question about, do we have an app? Now, we don't have it in the App Store, but if you load the site on a mobile through the browser, you'll get a prompt to add it to your home screen. And on Android or iPhone, you can click that. And actually on an iPhone, it's slightly different because you've got to click the share button at the bottom of the browser, and it will have an option where if you scroll to say add to home screen. But you can get it as a homepage app. And I'll show you actually. I've got it on. I'm not sure if you can see this. If I just take my screen off and show you just me, if you tolerate seeing me, you can see that the Stockopedia app as a home screen app is right there. And if I click it, it will come up. So it's pretty cool actually. And I use it all the time. It's a great way of, if I wasn't in airplane mode, it would actually load. But anyway, I didn't want to get any calls while I was on the webinar. So there we go. Now, I've had a look at a couple of stocks. I wanted to just share a couple of things that you might not know you can do. You can store notes on StockReports. So you can, and they get sort of tracked versus date. So you can add it and it will slot in and you'll have the date on there. You can also set the alerts. So the alerts are much upgraded in this new version of the site. You can get alerts on dividends, ex-dividend dates. You can get fundamental alerts. So, for example, the stock rank of this ever goes above 50, I might be interested. And, you'll get an alert. And that will alert not only by email, but also up here in the notifications section. So I quite find that really useful when things are going ex-dividend, etc., to get a notification on the site. So that's pretty powerful. So listen, I'm going to be, I had a bunch of questions about when to sell. I know there's a lot of you still on the call, so I'm going to keep going because I know a lot of you, often will say, okay, great, I know what to buy, I know what to filter out. When do I sell? So I've got a couple of slides on that, which I'll share now. because it's a difficult decision to make. People can find it very, very hard. And as I said, I'll share these slides with you after. Where did I put those slides? When should I sell? Yeah, so I mean, you either take the technical or the fundamental approach. If you're a long-term dividend investor and you're in great stocks, sometimes you don't want to sell ever. But there can be a number of reasons why one wants to sell. Quantitative reasons. A company might reach your valuation target. Now, that valuation target, it might be that you reach more of a valuation parity with a company's peer group. And that's where those traffic lights can come so useful. Deterioration of the valuation or the fundamentals as a whole. Keeping an eye on the value rank. The value rank is a pure measure of cheapness. So, in one's mind, you might think, well, if a stock's you buy it and it's on a value rank of 50, you might think to yourself, well, when it gets up to a value rank of like 15, I'm going to get out of it. Personally, I'm quite systematic in my investing and I can be quite ruthless. So if I see a stock rank drop below 80, I'm very, very hard and fast. I cut pretty quickly. But that does lead to more chopping in one's portfolio. That's on the more, my more active portfolio. But I do know a lot of really good investors. Phil Hoffer, who's often on the site and commenting, and he's really done fantastically well with Stockpedia. He's really, really dedicated active investor and uses the metrics. From memory, he told me he uses a stock rank cutoff of 50 very, very well. So he tends to get in when they're in the 90s, but he's happy to hold them until they're a 50 if everything is still going in the right direction. Now, of course, some of the things, some of this is quite contextual. If there are red flags that suddenly pop up, that can be an indicator that you might want to take seriously. I mean, you have to remember frogs kind of boil. I don't know if it's an urban myth, but the idea that if you put a frog in boiling water, it jumps out immediately. But if you boil it up slowly, it just sits there until it's completely boiled. So if you do own a stock and you've come to love it, like Burford Capital, and it shows like a red flag, often people don't jump out of the water. They can hold it. Now, one has to use one's judgment. It's a difficult thing if you're a long-term investor. And I know a lot of you guys are long-term investors. It's difficult. Qualitative reasons, loss of competitive advantage, sector management or business deterioration. I always think a significant deterioration in things like return on capital or margins can be a reason to sell. Profit warning, if you haven't read our profit warning research, do read it. I will sell any profit warning unless it's a super high quality company. So go and dig out our profit warning research. It's really, really, it will change your behavior. Jumping up short seller interest is another trigger. I also think it's very, very important to use a stop time. There is an opportunity cost to staying in a stock that doesn't perform. So I would say to myself, if a stock hasn't revalued within 1 year, I'm probably out. You've got to think about the opportunity cost. If the stock's gone sideways, you could have made 10% somewhere else. You hold another year, you might be 20-something% out of pocket. But there's technical reasons to sell as well. Long-term investors look away now, but I have been known to be very active in the market, and I'm thinking about being very active next year again and doing it possibly publicly. But some of the things I always like to look at, whenever a stock drops below a 200-day moving average, I really, really don't like it. And I'll show you how to get the 200-day moving average on a chart in a minute. But the 200-day moving average, if a stock's above it, the 200-day moving average is the average of its price over the last 200 trading days. And a generally trending share upwards will keep shifting up above its long-term trend. And remember, there's only 225 trading days in a year. So a 200-day moving average is most of the part of a year. Some people have said, if you can get stocks which have like a climax top. So sometimes people want to, take some off the table when a stock flies. I think iEnergizer is one I've been looking at lately. It's had a massive rally up. It's up, I think it's about 60% above its 200-day moving average. Something I got from Bill O'Neill is when a stock gets 60 or 70% above its 200-day moving average, it's going to come back down at some point or it's going to pause. So these can be very, very useful triggers for taking money off the table, selling outright, etc. And I think they're very valuable. in terms of stop losses, now this is a key point I wanted to talk about. So a lot of people make the mistake of using an absolute stop loss level, let's say 10%, and they find they get stopped out a lot. If you don't know what a stop loss level is, it's like if you buy a stock at 100 and you have a 10% stop loss, let's say around 90, you might get out. But stocks, as I showed you with the risk ratings, have wildly different volatility levels. So you really want to use a fraction of volatility or a volatility measure to set your stop losses if you do use them. So my own rule of thumb is half annualized volatility, which I've kind of laid out in this a little bit. So this looks at the risk ratings: conservative, balanced, adventurous, speculative, highly speculative, and it shows you the annualized volatility. If you think about it as approximate 6-month volatility, that can be fairly effective. So let's say you've got a conservative share, it's expected to move up or down 25%. If you're using a stop loss level of 12.5%, if you're a more active investor, that can help you look at a stock and try and, it often precedes a change in trend. But for more risky and more volatile stocks, you might want to have a broader stop. Now, your own fraction of annual volatility that you use depends on your level of proactivity, depends on your level of comfort with the losses. But you want to use much wider ones. I mean, speculative, highly speculative shares can have annualized volatility of 50, even 100%. And if you're going to buy one of those and you buy like a Serious Minerals, you might get stopped out at 25% stop very quickly. But if you're good at timing your way in, these kind of levels can be quite good. And at some point, we're going to build it into the product to help people with target prices and stop loss levels at some point. Anyways, I think that's fairly. Hopefully that's a little bit useful. I'm sorry, I'm not giving you completely hard and fast rules on some of these things, but it's quite useful to go over these things. So look, I'm going to go back to the site, and I'm basically going to just throw it open to you guys. I'll answer any Q&A. John's asking, can you put an alert on a screen when a new share qualifies? Well, actually, we have built that, but it's a little bit unreliable, so we're planning on adding it again. So I imagine it's not going to be too far away. But let me go back to the site. And so is the annualized volatility the same as the average true range on the chart? No, it's not. I mean, the annualized volatility you can add to a list. I don't know whether I can, I'm just going to add this to a random portfolio and click through. So you can add stocks to a portfolio. This is just me doing a test import. But what was I going to look at? Oh, yeah, I'm going to show you. You can customize a table, and you should be able to search for volatility. There it is. So you could add you could add 6-month volatility or 1-year volatility. If I add that here, confirm the column, save the table, and there you can see it. 62% annualized volatility on Serious Minerals. If I was to add a few more stocks, Burford Capital. Anyone got any Aussie stocks? If you are listening from Australia, do let me know. I'll just bring up some of the ones that we've talked about, and we might as well stick Apple in there as well. Let me just add those, bang them in, and you can see here the volatility. Burford Capital, 60% 1-year volatility. Again, very speculative at the moment. Games Workshop, 40%. If I add the risk rating in here, you'll see into the table. So I should have said, I forgot to add it. Hang on a minute. If I add the risk rating and I go and confirm column, save table, you'll see what I mean. This Apple is on just more than a conservative risk rating, 28% 1-year volatility. I mean, as I said, there's a kind of a proxy for what I like to use. 6-month volatility there. Save it. Oh, I keep forgetting to add it. Sorry about this. But this is just a nice way. You've got to confirm the column before you save. And you can see here, there's a 6-month volatility, which actually can work quite nicely as a stop level. So if we're going to look at Apple, for example, and I click through In fact, I should really quick click through to the chart, but you can see here it kind of went up to 224, came down to 156, and that signified a bit of a change in trend. So at a kind of 20% volatility, you might have got out and earlier, or half annual volatility at more like 14% drop. So these things can be kind of fairly useful, but that's one of the ways I'd like to look at it. And also, I mean, a lot of people who familiar with the old site. The Stockopedia rating, some of the things I talked about, you can find them in Browse under, look at the top ranked shares. We've got lots of these pre-rolled screens in here. So you can go and find, like, for example, top quality ranked shares in here to find the highest quality shares in the market. Gives you context, gives you some of the, shares in here. If I was in Australia, I could switch to it and, you see the highest quality Australian stocks, for example, on that page. Jumbo Interactive, never heard of it. When I'm next down under, I will go and buy some lottery tickets from them. Aussie stock DDR. Okay, thanks for bringing one up, Kevin. DDR is that I presume Dicker data. So oh wow, look at this. Okay. So I'll give you a quick lightning check on this. It's style neutral, so it's, as you can see, it's got really strong quality. I mean, it's got fairly good momentum. Fairly good overall stock rank. It's moderately valued. It's not overly expensive. Value actually has been improving recently. And as you can see, it's had it's obviously had a good run. Just like lots of these have the stock rank has come down to about 75 level. It's had this massive run recently. It doesn't look like there's no broker data on this, so there's no estimates. You see data not available. So what happens in this case, a good one you brought up here, Kevin, same for UK stocks, American stocks. If we don't have broker estimates, these forecast ratios will default to the trailing 12-month data. So you can see it all says TTM. That's quite nifty. I don't know why the brokers aren't following this, but that's quite disappointing. Very, very high quality share in terms of its sort of plain vanilla metrics. And again, no red flags to talk of, and it qualifies for O'Shaughnessy's cornerstone growth metric. So in this scenario, I've got no broker data to go on. I would have to go on the historic data, and it's had a pretty good track record the last couple of years of growing earnings. So that's pretty positive. I'm looking at this is pretty positive. Look at this. Return on assets going up and climbing all the time. Return on capital employed climbing. Return on equity climbing. I'd whiz down. I'd look at diluted weighted average shares. There was a little bit of dilution a few years ago, but not so much in recent years, which is a nice sign. It's heavily geared. It's got a lot of debt. Actually, you can see the enterprise value is 50 million above. So, these are some of the things I'd be looking at. So I would be just wanting to check out the debt level. Can you compare sector returns? Not at the moment. We're hoping to add sector, data in the future. You can, of course, go into Browse, click sectors, and you can look at them in this table. So I'm surprised we don't have the historic data of the returns in here. And you can look at industry groups here. There is a bug on sorting here. We're fixing that. Looks like we might have. I know we're fixing it this week, and actually it's quite disappointing you haven't got the price absolute change in there, but we will be adding it, and hopefully at some point we'll get hold of the price histories of all of these sectors, because that would be very valuable. But you can, of course, go and dig in and without building a stock screen, go and look at any sort of I know there's lots of miners in Australia, but pretty nice way of actually going and finding the highest ranked miners. Why are our sectors classifications different from the FTSE 350? Well, that's a great question. I should have actually talked about that. As I said, we use this 10 sector classification, which is based on the Thomson Reuters business classification schema. Now, there are a range of different sector classifications. There's GICS, there's ICB, there's FTSE. We use TRBC. It's very easy to understand, but also it's a 10 at the top level. There's 52 at the industry group level. It's actually got five different deep classification system. We're only publishing 2 of those classifications at the moment, but we might add more in future. We've even got down to a single activity. Now, the thing is, Thomson Reuters business classification scheme is actually, I find a particularly useful one. If you go into the Learn section, you can actually go and, I think, in here, search for sector classification, and you get an article all about it. And in here, there's a link to an independent white paper about why this is more effective for investors than GICS, ICB, or the FTSE. And it basically uses a kind of a very, there are plenty of reasons why it's better. But click on that independent white paper. I hope it's still available actually from that point, and you can read up about it. But that's how you go and do it. There's lots and lots of stuff in the Learn section. One thing I hope you're all spotting is that we've got this What's New section in the site, which you click on, you can see each of our releases. So since we released the site, we've done a couple of other major releases. There'll be another one this week, I believe, and another one, at least within 2 weeks after that. So they're coming out at a pulse, and you get like some good information. Okay, I know you're all running out of concentration, Steve, and I'm losing you. So another thing I just wanted to focus on, if you haven't yet used the new site, please do. It's I'm going to show you actually where to go. So it's on this slide. That's the URL, stockopedia.com/opt-in. And please do go, hopefully we can share it, stockopedia.com/opt-in. You can go back and forth and, as you wish. Bajaj Auto. You don't have a search bar on your Learn section. Okay. I'm just going to stay on while I've still got, quite a lot of you on there, because you've still got 360 people out there listening. And I'm really happy to keep going until you complete run out of steam. I do have a meeting in 15 minutes, actually. So that's probably my cutoff, and 2 hours is enough. There's a few requests for some things which we're going to add on StockReports. One of them that you've requested is major shareholder data. And we're going to add that. We do have the data. We've got a great database, and I'm hoping that we add it in, and which will show you all the ownership of the stock amongst fund managers. And I think that's going to be a really, really fantastic addition to StockReports. Some have asked for the dividend date to be published more prominently. We will do that. That's scheduled. There's a lot of little bits and pieces scheduled that we want to add in. So you'll continue to see these develop over time. So any other stocks you want? Where can you find debt, long and short term, not net debt? Well, you can go into some of the things I haven't actually shown you. I'm going to show you now. Some more features for analyze specific stocks. Obviously, I haven't looked at the screener, I haven't looked at the today page, I haven't looked at portfolios, focusing very much on stocks. I want to go through some of these tools. So balance sheet. You can go into the balance sheet and you can go and see total debt here. Now the balance sheet, these statements are really nice to use. You can look on an annual or an interim basis. At the moment, the current year is on the left because that's more like how a company would report rather than left to right like you see on the stock report. That can be a little bit confusing. But you get some nice popovers if there are any issues. You can see an auditor's opinion here. You can see the status of the accounts, etc. Now, in there, you can see total debt, total long-term debt, often broken out, and total debt there. So that's pretty useful for any company that does have significant debt. I would go and look in there, and also you do get some nice charts. They are pointing, as I said, right to left rather than left to right. Well, at least it lets you go and dig deeper as you wish. Again, income statements there, and cash flow, which starts at the net income and adds back things like depreciation, amortization, non-cash items until you get to the operating cash flow line here. And then it will add in all of the kind of add back the CapEx, kind of doing it in inverse to what I showed you on the stock report. And then you'll look at cash from investing activities, cash from financing activities, and the net change in cash. Always very, very useful. I'm also going to show you, you got dividend summary there. The charts are, I wanted to show you the 200-day moving average. So, for example, let's have a look at ASOS. And I'm going to just go into overlays, add the moving average here, and I'm going to change this to a 200. In fact, I like 200-day moving average, which is great on a one-year chart if you're looking daily. But one thing which can catch people out, so this is the FTSE here. Do you know you can change the color of these, which is quite nifty. So that's the index there, and this is the ASOS here, and that's the 200-day move. That's the 200-day moving average. If you jump to a very much longer time frame, like 5 years, the periodicity does change, and it tells you here. So, I would then want to move that to more like a 50-week average rather than a 200-day average, because 200 days is pretty much like 50 weeks. But you can see how useful this is as an indicator. In this share, ASOS, in its sort of big run up, you had this long time when it didn't really ever cross the 200-day. There's a little blip there. But when it finally did fall below the 200-day moving average, it collapsed. Now, for something like this, a high flyer, I would really want to look at a chart like this. I'm just going to save that as a template. There are templates down here, and this shows me my weekly moving averages. If I was to go and flip to, let's go and say Games Workshop. Let's have a look there. Right, you see you've got Games Workshop had this huge jump up. It fell below its 200-day moving average here. Actually turned out to be a false signal. So you might have missed out on the extra boost. But again, when there's a significant change in trend, a 200-day moving average, stock falling beneath it can often be a reasonable sell signal, especially in high flyers like this, those kind of growth stock wonders. And the other thing I always like to look at is when the brokers cut their numbers. You want dividend dates in the screener. Yep, that's a common request. Okay, Zero. We use Zero. At Stockopedia behind the scenes. Zero is an amazing product, amazing business. Isn't Zero a Kiwi stock? I don't know. Zero is actually. Why is it suspended? It's not currently ranked at the moment, which is a bit. Oh no. Okay, it's suspended in New Zealand. Not sure why. But anyway, yeah, here's Zero. Again, it's a high flyer. The rank is never as high for a high flyer because the value is super expensive. Investors love it. High quality, high momentum. Same thing. This massive, ridiculous EPS growth rate, which must be because forecast is coming from a loss-making position. So the forecasts are coming from like a very, very low position. If you see an anomaly like that, it's normally because of that. Strong relative strength over the last year. You can see it's significantly beaten the market. I'm quite interested in why the return on capital is looks good because it's losing money, but that's because it's in software industry, which has got a lot of like loss-making companies, obviously in Australia. But you can see lots of horrible metrics. So this is a classic example of a company that's ramping up its revenues, ramping up its sales. It's throwing money at the wall. It knows, look, we use it. We're probably never going to get off Zero. It's got customer lock-in. This is what I'm talking about. Scale advantage. They want to get to scale. Once they got scale, they'll turn it into a profit cow. So again, some negatives. Brokers are cutting the numbers. I'd also want to look at diluted weighted average shares. It's had a few issues in recent years, but nothing wildly aggressive. But you probably could expect some more dilution in future because if the cash balance drops, maybe they did something recently. It looks like they got lots of cash though. Six bagger for you. I'm sure it is. I'm sure it's been a fantastic stock. Can we use include investment trust for StockRank? Yeah, look, our biggest request is fund and trust data, collective investment data. We are planning on it. I'm not going to make any promises on dates, but you will see funds and trusts and ETF rankings and ratings come to Stockopedia at some point in the future. And we want to use all our stock ratings to bubble them up into fund ratings, and that it would be a very, very exciting thing. Right, I'm literally in my last 7 minutes. Maddox, you are saying you don't like the moving average box being on the chart. Something I could show you, and we probably will redesign the charts interface at some point. But if you've got a stock that's gone up and to the right, let's say like Gore, Games Workshop, sometimes if you're analyzing the share, it can get away. And I'm pretty sure you can actually remove those like that. If you go in there and you click names, it actually gets rid of them. And the moving average then shifts to the left. So that's quite a nice way of jigging it around. Although I think we could probably get a better solution for it than that. But, that might be useful for you. there's a nice range slider. I'm not sure if you're aware of. That's pretty cool too. There's lots of good toys in the charting section. Ashok, thank you very much for the compliment. I'm literally gonna wrap up now. I'm just gonna look at my slides and see if there's anything I can do in 5 minutes. Hang on, and see if there's anything else we could cover that I didn't already cover. The one thing I would say, and I didn't go over this section about choosing a strategy. This is about finding a stock market strategy that's your own and a portfolio building. Yes, Stuart, I know. I've done this very much as a StockReport webinar, so I wanted to focus on stock analysis. I'm promising to do more and more webinars in future, and especially around specific styles of investing. I want to go over this little topic again. My favorite guru is, I was a great fan of Jim Slater. He passed away a few years ago. I think what he did, mainly for what he did to the UK investment scene. He's less known internationally, but he's a real legend. And I still think he's got so many great insights for small cap investors. Read the Zulu Principle. It's just still full of great wisdom. But I want to talk about this because this actually is on that point. So choosing a strategy, right? If you map out these three main factors, this is literally my last 5 minutes. So this is all you're getting. Quality, value, momentum in this sort of Venn diagram, like I often show you. If you think about the deep value investors, Ben Graham was the first to really go into value investing. And like I said, if you only look at value, you might end up with value traps, which is why people started looking at quality and looking at that blend of quality and value. So in the quality and value bucket, you find a lot of people who've done very well in investing. Warren Buffett, he likes buying good, reasonably inexpensive stocks. Joel Greenblatt wrote the best book on this called The Little Book That Beats the Market that everyone should have on their bookshelf. It can be a little bit twee at times, but it's a fantastic read and it summarizes the contrarian way. Joseph Piotrowski. Neil Woodford is in that box, which I spotted just before I did the webinar. When he stuck to what he was good at before Woodford Capital blew up, it hasn't blown up, but it's had a pretty bad time. He was pretty much a contrarian investor. And that's the whole concept of buying quality merchandise when it's been marked down. A lot of people, there's so much written on this style of investing, which I call QV investing, that people that are, good quality value investors, and that includes a lot of dividend investors, they think momentum is anathema to them. They can't stand it. And they'll often say, how can you use momentum? Obviously, at Stockopedia, we use a slightly different form of momentum that blends the analyst momentum, as the earnings momentum, as well as the price momentum into one number. So it's not pure technical momentum that we use. But if you blend that with these other factors, these other intersections, quality and momentum, regardless of value, has been such a fantastic strategy for some legends of investing. Bill O'Neill, he's a great hero of mine, actually. Bill O'Neill, read How to Make Money in Stocks. It pops your mind. If you've ever been a value investor, I know I don't sound so Scottish anymore. I've been ruined by an English education, but I was always so tight when I got out in my first investing, and I really didn't like paying a price earnings ratio more than sort of 15. And Bill O'Neill taught me how to think about stocks and made me realize that high flyers, which can be on very punchy multiples, can make you so much money. So really worth reading. Mark Minervini, we've interviewed him a couple of times. He's got some great books. There's a Minervini thread on the site, which is really popular. And these guys, they make money out of good quality, growing momentum shares that are breaking out to new highs. It's a time-proven methodology. And the key quote there is, it seldom pays to invest in laggards. Look for leaders. But on the other side, and this is much lesser known, and it's one of my favorite strategies, and I'm thinking about switching entirely to value and momentum for next year. But basically, the quants are more into this. So you find people like Cliff Asness, you find a lot of research papers on value and momentum. It basically excludes any consideration of quality from and it really is trying to focus on finding recovery stocks or cheap stocks that are on the move. And you find James O'Shaughnessy said it was trending value was the best performing strategy since 1963. He's a huge sort of momentum backer. It can be hard for institutional investors to really profit from momentum in the way that they'd like, which is why you see so many big investors like trying to buy shares that have counter where the momentum's going the wrong way. But as a small investor, you can totally profit from momentum. It is the most popular, not the most popular, but the most powerful factor of them all. I had some questions about it before the webinar. And, a lot of people don't like using it, but ultimately it's like, the investor. So if you're an investor, a private investor, remember there are massive funds out there that have to move in and out of stocks gradually. And, they can have billions under management. And when you've got billions under management, they can't buy all at once. And because they buy in small batches and a lot of them have the same investment mandate, when they start liking a stock, it just puts this, tailwind behind it. It's like a rising tide. And as a small boat on that ocean, you can basically ride the tide. So as a small investor, I don't understand why more small investors don't use momentum, because it's such a powerful force. And if I was to show you on the site, you'd see that momentum works better than all the other factors. Now, I've got to go. I've got 1 more minute. Bang in the middle there, I put some mixed strategies from a couple of UK guys. Robbie Burns, I know, great advocate of the site, who's the naked trader. Slater also used all these different factors in his strategy, relative strength, price earnings ratio, all the quality metrics. And obviously, bang in the middle there is more like a sort of a composite stock rank kind of approach. But my key point is, discipline is the most important thing in investing. And if you can be disciplined in your investing, you're at such a huge advantage to other investors, private investors out there. Neil Woodford, he lost his discipline. Sticking to something and getting really good at a type of investing, reading up the literature in an area that you're interested in to give you more confidence to act even when things are going against you, I think is the most important point. And that seems like a pretty good time to sort of wrap it up. I've got a meeting now, so I've got to go. Thanks all very much. I can't believe 300 of you actually have stayed on to the end of the webinar. I'm delighted. And please do give me feedback give us feedback. We'll send out a survey on the webinar. I'd love to get any more feedback from you, because I want to do more material like this, and especially more on specific types of investing. Really glad we didn't have any technical glitches as we've had them before. And pretty much that's it from me. So best of luck. I know it's pretty tough out there in your investing and in the markets at the moment, but and especially the British investors dealing with Brexit. But I'm hoping that the markets will have sunnier times in the future, even if there is interim volatility. All right, take care, guys. Great to see you all.